Hey, good afternoon, everybody. You're all very welcome on to today's webinar. I'm just going to give it a couple of seconds there just to leave people filter in. Really do appreciate everyone's time coming on today. I do see a lot of familiar names as well. So thank you again for your support in our kind of webinars and our services over the course of 2022. This is the first webinar I'm doing this year. And I'm absolutely delighted that we have Ian Slattery, who is the Head of Investment Solutions from Zurich on. Just before we begin, I hope everybody had an enjoyable Christmas, and I suppose for myself and the team in Alpha Wealth and of course Zurich, look, we're just kind of wishing you all I suppose a happy 2023 and a prosperous 2023. So I suppose anyone who has dealt with Alpha Wealth in the past, I suppose, will be very familiar with us talking about Zurich, and I suppose how highly we rate them when it comes to managing our clients' savings and their pensions. I think Zurich have a very long history now of kind of demonstrating that they are one of the best, if not the best, fund manager in the Irish market, which is why we have so much confidence with them, and I think it's why we have over 3,000 of our clients at this point, including myself, invested with Zurich. Now, naturally, a lot of us will be, I suppose, conscious of the fact that investment markets weren't very, it was a challenge in 2022, to be fair. So that's why I'm delighted to have Ian on to maybe kind of give a bit of an overview of what happened in 2022, what the outlook is for 2023, and I suppose most importantly, just some kind of key investing principles and facts that people should bear in mind, I suppose, irrespective of the environment that we find ourselves in. There was a lot of questions that came in as well for Ian, and I'm sure we'll get many more questions in the chat box. So look, we'll try to make things as informal as possible and kind of do a bit of a Q&A, Ian. And look, we might just close off then at the end for people that aren't very familiar with Zurich. I'll just give a bit of an overview on how people can get exposure to Zurich savings funds and just what's involved there. So look, I might hand it over to yourself, Ian, at this point, just to kind of give a rundown on 2022 and the outlook for 2023 from Zurich's side.
Yeah,
and look, thank you again, Ian. We really appreciate your time today.
Yeah, no problem. Thanks, David. Delighted to be here, and good afternoon, everybody on the call. So just as David said, I'll start to share my screen in a moment, run through some ideas. Myself and David have a bit of a chat, and maybe we can already see the Q&A coming in there. We can box some of them off throughout the PowerPoint slide bit, and then we'll have a little bit of a chance to talk through it all as well. So just in terms of looking at the actual year just gone by, so it wasn't a very positive year for equities, and David's already mentioned that, and I'm sure people who've had reviews recently will have seen that as well. But what I want to do is just to kind of give some of the reasoning behind that, why we saw a poor 2022 and what the view from Zurich is. So when we look at the start of 2022, equities were actually at an all-time high. The highest level ever for global equity markets was the 4th of January 2022. However, we can see that we saw a poor first quarter of the year. We saw Russia invade Ukraine in mid-February of last year, a little bit of a recovery. We saw inflation surprise to a peak level in the US throughout the summer. Some comments from the chairman of the Federal Reserve, Jerome or Jay Powell, who spoke at a conference in August, which kind of rattled the markets a little bit. A little bit closer to home, we saw some of the kerfuffle, for want of a better phrase, in the UK with the mini budget, mini in inverted commas, from Liz Truss's short-lived government. We saw the US midterm elections, which saw the Democrats perform better than expected. And then into December of last year, we saw interest rates continuing to move higher. If I were to sum up in a phrase what we saw from markets in 2022 is we saw higher inflation, which was exacerbated or accentuated by the Russian invasion in Ukraine. That led to fears about higher interest rates. And you can see some of the topics on the screen are about that idea of inflation and interest rates. And those higher interest rates, as we all know, in terms of the cost of borrowing or mortgages and things like that, kind of puts the brakes on economic growth as well. So in a nutshell, what we saw for investment markets last year was higher inflation leading to higher interest rates, which led to fears over lower economic growth in the future. So one of the worst years we've seen in some time, the worst year since the financial crisis in 2008 from an equity perspective. Just to take a look at the sectors under the surface of it as well. I think this is always interesting. What I have here is the MSCI World, just where the cursor is. That's the global stock market. And you can see a lot of bad news in terms of the red. The one outlier is in terms of different sectors or parts of the stock market was energy, which is up an almost incredible 57%. In 2022. Now, of course, we know that the narrative behind that is around oil prices, gas prices, copper, gold, and the resource sector, which leads into energy companies being able to make more profit. But that's very much an outlier on the left hand side on the green. But we did see broad-based weakness, and some of the companies that have performed very well since COVID in the technology or consumer discretionary sectors, they were hit hardest because those sectors or parts of the stock market, they don't do very well or perform well when interest rates are moving a little bit higher. In terms of the main chart to look at, and I've loads of charts, but if I was to talk about one that I think kind of summarizes some of the debate and some of the things that people have been looking at is, this is US inflation. So when we say CPI, that's Consumer Price Index. So you'll hear that on the news talking about Irish prices as well. It's a basket of goods, and it shows how expensive it is to buy the things you bought last month, this month again. Central banks like this rate to be around 2%. And you can see, if you look at the red line, the core one, pretty much around 2% going back to January 2013. But you can see this big spike up that we see since the start of essentially 2021 through to 2022. And this caught a lot of people, including central bankers, by surprise. They thought inflation was, the phrase was transitory, that it would be peak and it would kind of move on very quickly. It was just pent up demand. It was this post-COVID readjustment. However, we saw that inflation proved to be much stickier than people thought. And again, when we talk about inflation, the way monetary policy or policymakers in general try and control the inflation is by raising interest rates. And what I have here again,
just to ask, I suppose, the slide there just on US inflation, we've seen signals of that kind of starting to cool last year. How does that compare to the situation in the Eurozone?
So US inflation is probably the most important because their interest rates are the most important. Inflation in the Eurozone is a little bit trickier because of the reliance on Russian energy sources. So we've all heard the narrative and we've seen a lot of diversification take place, but the Eurozone inflation is a little bit stickier and a little bit higher because of the input of Russian oil and gas. However, I have a slide in a moment or two on the gas price. We have seen, and you can see on this slide as well, if you look over on the right-hand side, that blue line and the red line starting the peak, it's starting to turn over, it's starting to move lower again, which is good news overall.
Thanks.
But what has happened is higher interest rates. So again, I speak about the US quite a lot because it's the biggest global stock market. Nearly 3/4 or over 70% of every equity in the world is in the US. And you can see this red line, which is the Federal Reserve moving up. We've also got the blue line. So anyone who's on a tracker mortgage or has been trying to remortgage or to coming to the end of fixed rates will have had bad news in this regard in the last 12 months or so, which is this blue line ticking up. What's happening there is that's central banks trying to control inflation by hiring interest rates. And based on that last chart, we're just starting to turn over and peak. We might expect to see some better news in 2023 on the inflation front. But we're going to have to take our medicine with the interest rates, unfortunately, as a result of that.
I think what's interesting on that as well, Ian, from an Irish perspective, is even though the banks have started charging us a lot more in our kind of on our debt, they haven't passed that on to savings and deposits yet. So look, it's just as important as ever to be looking, I suppose, outside of the bank, credit union, and post office when people are trying to, get inflation beating returns or even any kind of return at all.
I think that's a great point. Look, the business model of a financial institution is you pass on the higher rates on the mortgages and things like that straight away. You see it less or it's slower on the savings side. I think one word of caution, and I know David, you and Nick and the rest of the team would discuss this with clients quite a lot, is even if you do see deposit rates tick up a little bit, just remember the higher inflation. So even if you see savings rates go from 0% to 0.5% or even 1%, you're looking at inflation a lot higher than it has been over the last decade. And that eats into what's known as your real return. So again, if you're a long-term saving and you're looking to buy something in 7 years plus, whether that's say a child's education, long-term house deposit or in a pension product, You want to make sure you're getting real returns, and that's a positive return after inflation. So I think just to echo your point about continuing to look at alternatives to the credit unions or post office or anything like that, I think it's very important.
Yeah, spot on.
Yeah. I mentioned this just maybe on your previous point, David, just to bring this in. This is European gas prices. I think it's very interesting that we now see gas prices in Europe. We can see the big spike. And this is in and around the Russian invasion of Ukraine. We see the big spike then into the summer. And what was happening then was that was Eurozone or European governments trying to stockpile gas reserves in advance of the winter. And we see that the high for gas prices into September. However, you can see how much this has fallen off since, and it's I'm going to use the word interesting, but gas prices are now lower than they were at the start of 2022. So you have this scenario where one of the largest gas producers or suppliers in the world, in Russia, has invaded a European country, but gas prices have actually stabilized 12 months on, and they're lower than they are. And that feeds into lots of things. No, most importantly, the inflation figure, which again, energy costs, as those December bills start to hit the email or the post box in the last week or so. So again, we've had to stomach the higher energy prices. We've seen it at the petrol pumps, but we're seeing it come off then again, which I think is important. And where that feeds into, and this is kind of on the investment side again, we've been talking about the global economy in general, but I suppose when we're looking at funds and things like that, we're looking at multi-asset funds. So many people on the call might be familiar with the likes of the Prisma funds or the Balanced Performance Dynamic funds. And they're multi-asset. So we've got equities. So we spoke about how equities had a poor year last year, but also bonds had a poor year. So when we talk about diversification, ideally when one of them goes up, the other goes down, or they both go up even, but they're uncorrelated. But this higher inflation and higher interest rates is negative news for bonds. And I won't get stuck into the detail too much, but essentially this is the yield on bonds. So the bond yields have been trending lower for a long period of time. However, if you were to start to buy bonds now, they're at a level we've not really seen. If I take the French bond there, the darkest blue line, it's at a level we've not really seen since before the financial crisis. So what that means is for people investing in multi-asset funds or bonds in general, there are opportunities out there in the market at the moment which have not been seen for well over 10 or 12 years. So again, a lot of pain in 2022, but there are some bright spots when we look forward into 2023 and the rest of this business cycle in general.
It's a big change, Ian, I suppose, to the last couple of years where, people were pretty much relying on equities to deliver, I suppose, all the returns. It's probably going to have a big instrumental change for you guys go over the next couple of years, and that bonds won't, I suppose, solely be there as kind of traditionally as an a volatility dampener, but also an asset class that might deliver decent enough returns now over the next couple of years.
Yeah, bonds are now a live option in their own right. I think the best way I can describe that, David, is if we went back to a year ago, you were getting a negative return from holding a German 10-year bond. That return is now above 2%. So that's a fundamental. I know those numbers cannot seem massive depending on your context, but that's a huge shift in bonds. And it's a time for us as an active manager in conjunction with yourselves to be making sure we make the right decisions there to be able to capitalize on that for people. And what we've done in the last number of months is we have reduced our equity content in our multi-asset funds. So I think that's important to acknowledge. So what I mean by that is we're an active manager. So moving in and out of these asset classes is something we try to get right and try to bring value and add value over time. Increase some of our geographical allocation to the US, just as kind of a minor point. Continue to be more defensive on corporate bonds. So we've got government bonds and we've got company bonds. But we've also responded to higher interest rates within our bond allocations. I think that's really, really important. We're an active manager. When we see these things happen in the market, we don't get it right all the time. Hopefully we have enough humility to acknowledge that. But when we see sort of that 0 to 2% move in the German bond yield I mentioned a moment or two ago, that's something we can respond to. We can make an investment decision on the back of that. So we have moved in our equity sectors. We've moved in our geographical equity exposures, but also the types of bonds we're buying and the maturity of those bonds is something that we've looked at quite a lot. So tough year in 2022. We're not out of the woods yet in terms of that interest rate cycle piece, but there are always opportunities for good active management.
Yeah, we did actually get a question in Ian through email yesterday, I think, from one of the attendees, basically asking what changes Zurich fund managers have made in their kind of main funds to mitigate against any possible risks next year. So look, that's a really helpful slide, and I think it answers the question.
Yeah, so we're in, again, to try and summarize my answers at times, a little bit more cautious on equities and looking at bonds properly as a live option for the first time in a number of years, I think is the big shift in our mindset in the last couple of months. But I think it's important that while I'm talking about just 2022 or just talking about the last couple of months, that we all just take a breath and we kind of zoom out a little bit and remember why we're investing and why we're investing over the long term. So I know myself and David and Nick and the team, we probably think quite similarly about this, but I think there's just some good long-term principles of investing that are always worth reiterating. As you've probably guessed so far, if you've not met me before, I like complicated slides. So here's another one for everyone in the audience. But what I'm showing you here is the idea of equities in dark blue, bonds in the beige, and then a 50-50 split in the light blue. And if you were to hold equities any time since 1950 in the US over just 1 year, you could have returned 61%. Excellent news, but you could have also returned minus 43. Okay, so huge spread, huge range of returns when you just hold equities for 1 year. Bonds a little bit narrower, and then the 50-50 somewhere in the middle. I won't go through all these numbers, but the key point to take away from this slide is the longer you hold your investment, two things happen. Firstly, that range of returns narrows. You have more certainty in what you might get, and you'll also see it starts to shift upwards. So when we're looking over 10 or 20 years, there's hardly any instances of losing money, and there's no instance of losing money in the 50-50 portfolio. So I think it's really, really important that the longer we hold our investments for, the more likely we are to have a smaller range of returns, and it's more likely that that's going to be a positive return as well. So whilst 2022 is just happened, it's right in front of our face, it's the thing that hurts right now, I just think it's always worth having a think of some of these slides at times as well.
Yeah, I think particularly as well, if you look at over the last 5 years, I mean, we've had so many challenges like, COVID, the war in Ukraine. I mean, if there was ever a period to, I suppose, emphasize that long-term investing will, I suppose, get returns for investors, and the market will rebound strongly after large falls, I think, that period probably was it,
Yeah, definitely. And I think, look, COVID was a great example of that. We've had a good start, again, not to focus on the short term, but even the start of 2023 has been positive again as well. Funds are up a couple of percent. So there's always goes ups and downs, but you smooth that return with your holding period being pushed out a little bit longer. And I think this slide as well probably points to that as well, is what I'm showing you in the red dot is the most money you could have lost in a calendar year in European equities. So if you had bought at the highest point in 2022 and sold at the lowest point, the worst possible decision, you would have lost 21% in 2022. You would have lost 5% in 2021, 34% during COVID in 2020. However, you'll notice what I have in the calendar year return in the blue bar is what you actually gained over that year. And what you'll see is the red dot is always lower than the blue bar, which means is if you held it for the full year, you would have returned better than panicking at the low point as well. So I think that it's just to make the same point at the last chart in a slightly different way.
Yeah, because there was actually, sorry, I was just saying there was actually a question that came in and from a lot of people asking, should they, reduce their risk in their pensions and savings in light of, I suppose, everything that went on in 2022 and maybe some forecasts for 2023. And I think that slide is very, very powerful, just to, I suppose, to emphasize that's usually not the smart thing to do.
No, it's a great question because the answer is very definitive. And the way I answer that is 2022 might have been a poor year, but if your personal circumstances haven't changed, if your job, your family, your commitments, your aspirations, your goals, if all those things that you've sat down with David or Nick or any of the team, if they remain the same, invariably the fund choice you had 12 months ago remains the same choice, the way I put it. Yeah. And just the last point for me, I find this interesting, so hopefully other people will as well. There's a lot of talk about some of the big tech companies have had a poor 2022 after leading the market for a number of years. But if we just take every decade going back to the 1980s, there's always these narratives, there's always these themes that play out over time. We had the idea of oil was going to take over the world, which it did in the 1980s. Japan had a great 1990s until that bubble bust. We had the dot-com bubble. We had the rise of China. We have the mega techs in the US. But the thing is it's important that people don't get caught up on some of these trends. Just trust your financial advisor, trust your fund manager to take advantage of these trends as they see fit. And it's nothing wrong. There's nothing unusual with seeing the biggest companies in the world start to change and some companies come more into vogue. And that again is the opportunity that we're trying to take advantage of as an active manager. I'm conscious of time, as always. I've probably spoken for longer than I should have. But in summary, before we go to a bit of a Q&A, brighter outlook for 2023. There are opportunities there, particularly bonds back in play. Inflation is going to be a keyword. It was the keyword for 2022. It's likely to be the keyword in terms of those expectations for 2023. And just the last couple of slides, very much about stick to that long-term plan. Always talk to your financial advisor. If you're looking at a big decision, always kind of get advice and talk it through with somebody. But with that, thank you very much. I'll stop sharing my screen and we can maybe have a bit of a chat, David.
Yeah, just looking at some of the questions that came through, Darian, one area that I think is really, I suppose, interesting is somebody asked, has the market already priced in possible recessions this year, given the fall last year? We are always talking to clients about, I suppose, markets are forward looking, and it's not really a case that somebody comes on the radio in 2023 says we're in recession and markets fall. And I think a lot of people probably mistake that is the situation,
No, that's it summarized perfectly. Like, I think historically equity markets tend to bottom out somewhere between 3 and 6 months before the recession actually gets called. So they are forward looking. We saw that during COVID. Equity markets recovered much quicker than the economy, things like that. Equity markets actually bottomed out in March 2020, just when we were going into our first lockdown in Ireland. So again, the forward-looking nature of stock markets is a very good point to make there, David.
Yeah, perfect. There's just another question there, another kind of, I suppose, area that we're discussing a lot with clients in terms of kind of investing a lump sum or, using dollar cost averaging. Given the volatility in the market at present, would you suggest investing a lump sum in one go at the moment or phase into the market gradually?
So the maths, in hindsight will be 2020. So the maths will tell you whether putting in a lump sum or putting in unit cost averaging or dollar cost averaging month on month. Depending on how the fund goes, one will be better than the other. What I will say is it's a really, really good idea if you're a little bit nervous. If you think about the behavioral side, ask yourself, if you put that lump sum in today and it was down 10% next week, would you be okay with it if you're a long-term investor? If you're not sure the answer to that, maybe the unit cost averaging piece is the way to go. It can help keep you on track a little bit more. You're just drip feeding into the market over time. So I do think it's doing one or the other rather than option 3, which is to do nothing, is probably the most important bit.
Yeah, spot on. Yeah. And I think it really does come down to the individual, as you said. Like me, for instance, I work in investments, give investment advice regularly. So I see myself as kind of the invest and forget guy, in that I'm happy to drop a lump sum into something, keep it that long-term view in mind. And even if it falls 20, 30%, I'm not really concerned because I have the long-term view in mind, whereas there might be somebody else who, is losing sleep over something like that. And that's where I think the kind of phasing into the market and the dollar cost averaging and reducing that time and risk in the short term is relevant for some people.
Yeah, and look, that's the sort of stuff you can trash out when you actually sit down and kind of get into the detail with someone as well, what works best for them.
Yeah, spot on. We'll just see there now. Person asking, their pension value fell over 12% last year. Is that normal?
No. So again, I'm a great believer in looking to history. It was one of the worst years ever. This is not going to be nice to hear, but it's reassuring maybe in some ways. It was one of the worst year ever for multi-asset funds because we had that twin fall of equities and bonds. For equity markets, it was the worst year since 2008. So again, 14, 15 years. But it's worth noting, we saw a fall in the late 80s. We saw the dot-com bubble around the turn of the century. We saw the financial crisis, 08, 09. We've seen, let's call it peak inflation or whatever phrase we want to, someone will coin a phrase for what happened in 2022. But if you're on a 30, 40 year journey of investing, as most pension people will, you kind of have to expect a double digit fall at least once a decade and a 5 to 10% to fall even more often than that as well. So it's not nice. it doesn't feel nice at the time, but when you're on that journey, kind of expecting it is kind of half the battle. So it was a poor year for markets last year. There's no getting away from that, I suppose.
I suppose in the context of the market overall last year, though, and let's say all the funds from all the different fund managers, 12% probably would have been normal in that context. But I suppose historic, it's not.
Sorry, in terms of our cost of market, multi-asset funds in general were down between 10 or 15%. Now, other parts of the market, like cryptocurrencies or more tech-orientated pieces, were down a good bit more depending on your actual investment. So even though it mightn't feel like it, being down 12% is actually a good advertisement in terms of what actually happened in 2022 for having a right risk level and having a diversified approach.
Perfect. Just maybe do two more there, just conscious of time. Taking recent market performance into consideration, do you recommend increasing the amount I save or invest each month? And if so, why?
I think I would save as much as you can. I think that's probably the short answer. I do think, obviously, when someone sits down with the likes of yourselves, there's probably protection needs. There's more tax efficiency in a pension than savings. So there's always a need to have an emergency fund. So there's always the priorities there. But I do think the general sentiment of putting any spare money you might have to work, it's hard to argue with that as a concept.
Yeah, I suppose, and on the flip side as well, markets still are at a bit of a low point, so there is opportunities there for people as well. Probably the most valuable contributions to pensions and savings are when markets are at a bit of a low point. Ian, I take it as
definitely, if you're able to do a lump sum at or close to a market low, which we've seen obviously so far, it's definitely going to help that long-term returns, which benefit from the compounding over time.
Great. And just before I suppose I lead into, I suppose, giving people a bit more information on how they can get exposure to Zurich savings options and what's involved there is just one final question. How would you compare saving in Zurich funds versus saving in the credit union or post office? I'll be going into that myself a bit, but look, I might just let you kind of take it from the in-house view.
Yeah, look, we have a good track record for investing. We've been doing it since the 1980s in Dublin. We've well over 30 billion under management. We stick to our process. It's tried and tested. And it goes back to earlier comments. If you want inflation beating returns that you're able to afford that thing you're saving for, whatever it might be in your own financial plan, getting exposure via investment funds will outperform what you get on deposit in whatever financial institution over the long run. And I think that's a very, very key point.
Perfect. Ian, look, thanks a million for your time. We really do appreciate it. Look, there was some very valuable nuggets there for both myself and everyone on, I'm sure. I'm just going to kind of take over there and just share my own slides for anyone who is wondering how to get exposure to Zurich savings plans. Ian, you might confirm there if you can see.
I can indeed, yes.
Perfect. Yeah, so just on the back of everything Ian was saying, I think the kind of main, I suppose, messages there is that, like, irrespective of the environment we find ourselves in, it is still really important to look beyond the bank, credit union and post office. And whilst deposits, cash are, fine for short-term savings, so anything that might be coming up in the next, say, 1 to 3 years, they're not really appropriate over a medium to long-term period, because as Ian was saying, they will fail to keep pace with inflation. So if you take Michael here, who was 100,000 in on post, earning 0.5% per year, which is the return here on the National Solidarity Bond, that's 2% over the 4-year period, so 0.5% per year. The impact that inflation is actually going to have on Michael's money, despite that money being, guaranteed and tax-free, is quite devastating over a 10-year period. If you look at a more normalized long-term inflation rate, the 100,000 decreases in terms of its purchasing power to about 78,000. If we're looking at higher inflation rates that we're seeing at the moment, 4%, the 100,000 reduces to 71,000. And 5% inflation rates, the 100,000 reduces to 64,000. So it just goes back that there to the old adage that there is risk involved in everything you do, and you want to make sure that you're taking the right level of risk relative to the term that you have in mind and your goals. So I suppose in light of that, back in 2020, we set up something called the Alpha Savings and Investment Club, which is basically, I suppose, to educate Irish people on some of the alternatives that are available in the Irish market when it comes to both saving on a regular monthly basis and or maybe investing a lump sum. And I suppose our mission statement there was that we wanted to help people achieve their financial goals and instill good savings habits that will keep their hard-earned money working harder for them rather than sitting idle in the bank, credit union or post office. And of course, our favorite plan, and the plan I would suggest as being, the best plan in the Irish market, it's the plan I use myself, it's the plan that we have over 3,000 clients invested in, is the Zurich Easy Access Savings Plan, which basically allows people to save on a monthly basis from as little as €100 per month or invest a lump sum of €5,000 or more. What I like about the plan is its flexibility, and that people can increase, decrease, stop or restart their savings at any stage. And the plan is also, the term is open-ended, so basically people can take some or all of their savings out at any stage at no penalty. But of course, I do suggest that people, go into this with the notion of maybe leaving it there for at least 5 years, just to kind of ride out any kind of short-term volatility in markets. Just going back to some of those slides that Ian was showing earlier. Within the realms of this plan, people have access to a wide range of market leading and award-winning funds from Zurich that have a really good track records. And, the funds range from kind of low risk funds right up to moderate risk funds to high risk funds and everything in between. So there is an option there for pretty much everyone. And those risk levels can be changed throughout the term. Just to give people an idea of some of the funds that Alpha Wealth normally suggests as part of this plan, a lot of our clients are exposed to a 50-50 split, 50% going into Zurich's Prisma 4 fund, which would be their moderate risk kind of house fund, risk level 4 on a scale of 1 to 7 traditionally, and 50% going into their balance fund, which is one of their oldest and most popular funds. And going back to what myself and Ian were speaking about earlier, I suppose if you look at over the last 5 years, a 5-year period, that's seen a lot of challenges with, COVID, the global economy shutting down for a period. On the back of that, the war in Ukraine, the correction we've seen in the last 12 months or so, the funds have still delivered returns in excess of 22% in the Prisma 4's case and 28% in the balance funds case, which just goes back to the importance of staying invested and keeping that long-term view in mind, making sure that you're in a diversified portfolio with a good fund manager like Zurich. This is just showing you guys exactly what the Prisma 4 and the Balance Fund are made up of. So people are getting exposure to, a very, very well diversified portfolio at very low entry levels, which is managed by Zurich. On the balance funds there, you've 65% in equities, 32% in bonds, 3% in cash. And on the Prisma 4 fund side, it's a bit less in the equity side, so you're 48% in equities, bonds, which Ian spoke, a lot about earlier, 9% in alternatives, 5% in cash and 5% in property. So these are what are called multi-asset funds, as Ian referred to earlier, in that you've exposure to, many different assets within the one portfolio. And the allocations can change, of course, depending on how Ian and Zurich see the world, to, I suppose, try to mitigate those risks and seek out returns for investors, regardless of the situation we find ourselves in. As it happens, the most popular reason people start the plan like this with ourselves is to save for kids' education costs, which are, a massive financial burden for a lot of parents. And Zurich done some, surveys on this a couple of years ago, and they found that unfortunately at the moment, about 52% of Irish parents go into debt to finance third level education. You can see the projected costs of third level education. So if somebody is studying while they're at home, the annual cost can be, up to 4,894. Which rises to €9,000 a year if somebody's in rented accommodation. If you look at the full lifetime cost of a third level education, which can range to 4 to 5 years, as we know, it can range from 20 grand per child right up to 36 grand per child. So it is a huge cost that people need to be planning early for. And I think a plan like the Easy Access Savings Plan, helps people plan for that expense and really takes pressure off in their later years and avoids people having to take out loans. Now, in my experience, people are usually in a pretty good position if they can afford to put the child benefit of €140 per month away early on, and earning a modest enough interest rate, it can accumulate to a fairly sizable amount over time, benefiting from compound interest in the funds, like we showed earlier. So just through regular contributions of 140 per month, saving after 18 years, which is typically the time people start third level education, you could have 42,000 euros saved up if earning that 3.5% interest rate. If you're in a fortunate situation where you can invest, say, a lump sum of 10 grand in addition to 140 per month, you'd have 54,500 built up over 18 years, which I'd like to suggest will put a fair dent in those, I suppose, third level education costs. The only thing required from people on the call to set up a savings plan through ourselves with Zurich is be prepared to save as little as 100 euro per month, or a 5,000 euro lump sum, or maybe a combination of both. Be prepared to save or leave that money there for at least 5 years, although you can access the money if you need to, if there's an emergency. And of course, to just set up a call or a meeting with one of our qualified advisors to discuss your needs and get an appropriate plan in place for you. For those of you who might not know much about Alpha Wealth, some of the other areas that we can help people with include things like, independent mortgage advice, protection reviews, pensions and retirement planning advice, more specialist things like estate and succession planning, child savings plans, as we said, and tax back investment options. We do offer a full financial planning consultation to our clients, which is usually a once-off cost of 199 euro. But we do like to give people on the webinars a bit of a discount. So that is I suppose a discount, a 50% discount, to reduce that to just 99 euro for webinar attendees. What the review basically entails is, firstly, reviewing your current financial situation and plans, setting financial objectives and goals such as clearing your mortgage, planning for education, or retiring early, providing a cash flow model to predict your future financial situation. We'll then map out a financial plan to help you achieve your objectives, all while trying to identify ways to save you money, reduce your tax, and make your money work harder for you, utilizing funds like the ones Zurich provide. So look, just want to thank everybody, and also thank Ian for your time and his time. I hope people I suppose found that beneficial. And look, my own contact details are on screen there. People are more than welcome to reach out to me to query any items on the webinar today, or to discuss any areas further. Perfect. So look, as I said, thanks for your time, and hope everybody has a good day, and wishing you all a happy and prosperous 2023.
Thank you, David. Thank you, everyone.
Thanks very much, David. Thanks, Ian. And just say that there were a few questions that came in on the Q&A, which I actually answered on behalf of David and Ian, and thank you very much for those. And if anyone else does want to throw any questions in, obviously please feel free to do so in the Q&A there. I'm sure David can maybe answer them very capably, much more so than myself. Thanks so much again, guys.